Hi, and welcome to Jenkins Guide on Risk, the YouTube channel dedicated to theory and practice of risk management. In this video, I'm going to show you how to model risk capacity as part of a corporate decision support tool for risk management. In earlier videos, we've looked at how to define risk capacity and how to think about it. In this video, we're going to get a little bit more practical about the whole thing. And all right, for more on risk capacity, please consult my book, Empowered Enterprise Risk Management, co-authored with Peter Kapstad. There's also more information on my webpage, riskbudgeting.se, and as they say here on YouTube, please like and subscribe. So just to recap a little bit from the video on how to think about risk capacity. We were saying there that there's something called risk capital, which is kind of loosely defined as the amount of capital needed to support the desired level of risk taking. So business is risky, right? And to support this ongoing value creation process, you need some buffers in place to deal with worse than expected outcomes and variability in performance. So you need a buffer or resources at hand from which you can draw when there's a need to, so as to keep your strategy execution going, right? And it turns out that strategy is very much a function of financial resources and financial health. You can't execute your plan and your strategy optimally if you're short on funds, if you're financially constrained or even distressed, right? So risk capacity is a liquidity oriented concept compared to economic capital, which targets solvency and survival in a more direct way. Here we're talking about cash buffers intuitively now, cash buffers that we need to ensure that we can invest optimally even in a worst case scenario. If you want to be a little bit more nuanced about the whole thing, we are talking about conditional cash consistent with a certain target probability of falling short of cash commitments, where it's understood that these cash commitments are related to strategy execution. You need to meet these payments on an ongoing basis to function as a firm and to implement your value-creating investments, etc. So falling short of cash commitments means suboptimal strategy execution. So we have this picture here showing the outcome distribution for operating cash flow. So this is the variability in performance that we need a buffer against. There's some tail risk over here, and we need to service or meet these cash commitments indicated by this line. So there's a shortfall starting here, which is then absorbed by risk capacity to the extent that you have any. And that will absorb these losses or shortfalls and make sure that you can keep going, right? You have the liquidity you need to implement your strategies, right? To a point when risk capacity is depleted and you can't keep your cash commitments up any longer, meaning that you will scale back. And that is most likely going to be capital expenditure, first in line, so that we can interpret this breach here as an underinvestment. And this probability here, the remaining tail of probability is gives you the probability of underinvestment. So the whole thing about risk capacity is that it absorbs cash flow shortfall. So it reduces risk that way. And the cash flow shortfall will then be the difference between cash commitments and operating cash flows, and zero otherwise. So it's only when cash commitments exceed what we're able to generate in the business that we need, that's a cash flow shortfall then that needs to be absorbed by some financial resources. And risk capacity then are whatever cash resources we have already, but also conditional sources of liquidity that are available when a shortfall has happened. So we have current or available excess cash and equivalents, cash at hand, and to that, we will add spare debt capacity and derivative cash flows. These are conditional sources of liquidity. We just have to verify that we believe they will be available even in worse than expected scenarios. So it's not, it's not a fair weather kind of assessment here. We have to anticipate how this would look in one of these worse than expected outcomes. Are these sources of conditional cash reliably going to be there for us? Then it counts towards risk capacity. So we're saying now that we can model this explicitly as part of a corporate risk model. So we're essentially talking about balancing variability in performance, performance risk versus risk capacity. So risk capacity is there to absorb this variability and like a shock absorber, right? So, and we do this in the context of risk budgeting, which is an enhanced model for financial forecasting and enterprise risk, where we ensure that we have accounting and analytical integrity in the model. We add to that a layer of risk exposures and thresholds. This is a structure for risk analysis. And we then use this to proactively evaluate the risk and return profile of different corporate policies. And we run many scenarios through it to be informed and avoid surprises and find value optimizing policies. All right, that's been extensively described in my video, so I'll be short on that. I'm also gonna just briefly mention that we generate revenue simulations here using a simple model for that. This has also been covered in other tutorials. So we have an exposure model here that connects revenue variability with the a risk factor in this case, which is the oil price. So which in turn is simulated by this model. We may generate a forecast. This has been estimated on historical data. So we take historical values and feed that into the model to generate forecasts and come up with some numbers here. So we first of all generate the forecast for oil here, which is sent through this model here to generate a conditional forecast of revenue. So this revenue forecast will vary with the forecast here, which is now risk adjusted because we have information on the variability around the forecast, like the magnitude of the forecast errors here. So we've risk adjusted the model now. So it's not just a forecast, but also we have the possibility to simulate these risks and run many thousands of scenarios. And we're going to do that using @risk, which is add-on for simulations that you can, it's Excel based, and you can risk adjust your spreadsheet models and run simulations. And so we do that. We've set the model up for that, and we just execute these simulations, and we now have a probability distribution. This is the forecasted oil price, but there's uncertainty around that forecast. It can take on many different values with different probabilities. Because revenue is linked up to this oil simulation, this will be a conditional distribution now, because every time we draw a random number for the oil price, this implies a new conditional estimate of revenue, right? So we get a revenue simulation going as well here. All right. So what we've done here is to link the revenue simulation up to here. So this is not going to be a simulated number. So the entire spreadsheet is going to be risk adjusted. I've assumed some numbers for various costs here. So we get an operating income. There are numbers now for interest expenses coming from a debt over here in the balance sheet. And we're going to, this is the strategy we're talking about. To execute the strategy, we want to invest in plant, property, and equipment. That is the investment required to get the value optimizing strategy in place. That's how we're going to think about it. All right, so these lines are now commitments. We need them we need to take care of them and meet them in an orderly and timely fashion to enjoy optimal strategy execution. So these two put together are our cash commitments then. If we fail to make good on these, we're talking about some serious negative consequences where we have underinvestment and financial distress on the horizon if that is the case. So cash flow shortfalls are only registering something to the extent that operating cash flows fall below the sum of these commitments, which is not the case here. So it registers as 0 for now. But as soon as we start simulating, all these numbers will move around and be recalculated according to the this variability in performance, and there will be scenarios in which there is a cash flow shortfall registered. So we can actually designate that as a risk output using the menu in net risk, and analyze the risk, the funding risk here. So that in this case, this all goes back to the oil price being simulated and deriving conditional estimates of revenue. That sort of travels through the financial statements here, and in a certain number of scenarios, that shows up as a cash flow shortfall. And here we can get a glimpse of the magnitude. I mean, in most cases, it's going to be zero. So the expected mean is quite low here. But there are scenarios, there's some tail risk here where the cash flow shortfall gets substantial. And the question becomes, can we absorb these? Do we have risk capacity enough to deal with that? So we have to define what we believe to be our risk capacity, and we have some value going into this. This is a starting balance. But we're not going to assume that we can draw down and deplete this cash reserve completely. That would be imprudent, right? Because we need some around to function as a business for operating purposes, these ongoing payments, etc. So let's say that we at any given time want to have a minimum of 500 million in cash, and we would never consider going below that because that would be too risky to do, some pretty serious consequences there. So, but that leaves 500 as excess cash that we're willing to sort of use to absorb any shortfalls, right? We also have assessed that we're able to go to a debt to equity threshold of 1 at the very maximum, at the very most. That beyond that we're not going to tread. That would be imprudent or impossible. Maybe the bank is even declared that that's the absolute limit. That could come from a loan covenant, etc. So something that imposes a certain constraint here in terms of, and that is 1 for now, we're saying. So any funding need below that, we're saying that we can deal with it, like as long as we're not going above that threshold. So we're now adding another computation here to the model. We have a financial ratio then, to which is connected our risk assessment, and that whenever this ratio here goes above 1, well, that will count as risk, because we're at that point we're no longer able to support these cash flow shortfalls. We're not able to absorb them. So but how do we take care of this practically then? Because it's one thing saying that there's a certain limit here, but we need a way to sort of take care of that in practice, and that is going to happen on the proceeds from borrowing line. We're going to set up a formula here so that it maintains the target balance for cash here. This will not go below 500 because that is what we need at a minimum to run things. So we have to cover any negative gap here with new borrowing so as to make sure that this is always 500. Then it may also need to register more borrowing to maintain the investment here. The question is, to what degree is that going to be possible? Well, that is going to be given by this ratio here. Whenever it's above its threshold 1, we're going to assume it's not possible, and that cut in cash commitments will be necessary. So we're setting up proceeds from borrowing in the following way: that whatever cash is going in, we're adding to that through operating cash flow. And net investment cash flow tends to subtract from that, right? So and there are other financing lines where we may anticipate a cash in or outflow. The sum of that is going to be sort of the available cash resources prior to any borrowing. So the question is, if it's below the threshold, well then, we're going to have to cover that. We're going to instruct the model to borrow, so to speak, or there's probably not going to be a direct line to the bank, but I mean, it will have to register as if we were borrowing. And so whenever it's below the critical threshold, that's a signal that we're going to need to borrow more. All right, so whereas then it's 0 otherwise. So this part of the formula takes care of that. So it makes sure that it covers any difference. So up to the critical threshold level of cash. all right? Otherwise zero, because there's no need to. You have the cash you need already, and more so. So you don't need to, the model is not going to be assuming borrowing in those outcomes. So essentially what this formula does is that any negative deviation from target cash, there's borrowing to cover that. All right, so it's kind of absorbing that. So that's what the formula does. So here's a stressed scenario. We're assuming a very low oil price now. And you can see that over here, there's a very negative development in revenue compared to the previous expected scenario. And meaning that cash develops more negatively. And actually, if it weren't for borrowing, it would go below the critical threshold. But we've instructed the model now to borrow so that we're at least able to show that minimum threshold, which we need for operating purposes. So here that happens. The model will assume that these are cash inflows now that will move into cash to the extent needed to arrive at the 500 in critical level for cash, right? So but there's more borrowing than that, which goes towards investment in PP&E, right? Which is the strategy execution part of cash commitments. And we're finding that as this happens, in this very bad scenario, we're actually exceeding the limit. To be able to do this would force us to go above the threshold, the critical threshold. And maybe we're not willing to do that or even able to. I mean, the model doesn't distinguish at this point between that, but for whatever reason, we are assuming that's not going to be possible. So we're talking about an impossible situation here where, we're either breaching the critical threshold here, or we're cutting back on something, which is going to be investment in PP&E most likely. So one of those two things has to happen. Something has to give. And we can actually just analyze, to what extent that, we're seeing these cash flow shortfalls here and new borrowing at the same time that this one is over 1. That is going to give us the probability of underinvesting. So we're going to define an underinvestment event as debt to equity being above the critical threshold. That's when we know that we've taken the borrowing too far. We can't really go there. The model is showing it for now, but we know that this is impossible, or we're not going to assume that that is an impossible or acceptable outcome. So if that is above the critical threshold, there's a 1 being reached. That's a risk event. A 1 is risk. It's a bad outcome. Otherwise 0, we're fine. We're within our limits. And then the probability of underinvestment will be at risk. There's a very neat functionality for this. You just tie the risk mean function up to that dummy variable here. This is an output this is a cell in Excel where you've programmed this formula. So you can now just take the risk mean of that, and it will report the probability, the number of times that happens as a fraction of the total number of simulations. And that's the probability of underinvestment. So let's say you run 10,000 simulations. In 1,500 of these, this dummy variable here will take on the value 1. All the others, it's going to be 0. Then you can infer that the probability of that happening is 1,500 through the 10,000 simulations that you run. That's the fraction of times it is occurring. So that's corresponds to a 15% probability, and that's then we would, we would think of that as a probability of underinvestment in this case, because we can't go above this limit, right? So what's going to happen rather is a cutback in capital expenditure, which we interpret as underinvestment. So these two, there are many ways you could set it up. This is just one, but I find it one of the simpler, and it gets the job done. So we're allowing the model to keep a positive cash balance, which is realistic, and the borrowing sort of is what we then focus on. How far can we take that? We know that there's a certain limit here. Anything above that limit realistically can't happen, and we can assess the probability of that. It doesn't matter. We don't need to instruct the model to start cutting capex because, we know that this is what will happen. So we get the right interpretation of this number here, the probability of underinvestment. So we can now simulate. Remember that we have the revenue risk in place, generating cash flow shortfalls. Now we have a way to, and in some of these scenarios, those shortfalls and will be too large, so that we don't have the possibility to cover them by drawing down on the cash first of all, and then new borrowing. I mean, we're simplifying away derivatives for the time being. That will be another video. So, and it turns out that with this configuration of inputs, then there's an 8.2 probability of underinvestment. That is what the model indicates. Out of these 10,000 scenarios that we run, in some 800 of them, the shortfalls will be such that you are actually exceeding your constraint, implying that there has to be a cutback in capex. So coming back then to the definition of risk capacity, it's a conditional cash, which is what we're analyzing here, consistent with a certain probability of not meeting cash commitments, which has the interpretation here as underinvestment. So what if this 8% is too high? Then we find, maybe these are very good projects and it would be a terrible consequence if we had to cut back on it. Well, we would try to add risk capacity then, so that we get a more likable or acceptable probability of that happening. So what if you, for example, issued some equity to shore up your liquidity position? You have larger buffers now, and you increase the distance to these threshold levels. So here you add to the cash position, and it's an equity financed one. So this is definitely strengthening your buffers, right? And we rerun the whole thing. We just change the configuration. We have more risk capacity. We simulate, and we find that okay, now we have a 2% probability of underinvestment, which is maybe something we can live with. But after all, adding risk capacity is expensive as well. We don't want to add equity unnecessarily. So we can discuss. A lot of times what we do with these models is to generate a topic of conversation, right? It doesn't deliver the truth, but we can talk about this now. Is it prudent? Is it worth our while to do something like this to get risk down, or is it better to just live with the risk, and that's going to be the value creating policy after all? So yeah, we now have a completely different way or material for making informed decision about risk and return. So risk capacity, to summarize, is the conditional cash consistent with a certain probability of falling short of cash commitments. And we're thinking of that as primarily underinvestment. And these components of risk capacity, we can model them quite explicitly as part of our risk management effort here. We have a decision support tool for that purpose. So we can sort of quantify and manage enterprise risk. And we can evaluate different strategies for boosting or reducing risk capacity, so that in the end we are comfortable with it and we think that we're on the right track. This is, under the circumstances, the best we can do, and the right risk return profile. And yeah, so that summarizes. There's more in my books, more on my webpage as well. Please like and subscribe, and have a good day.